Good morning, everybody. I hope everybody's doing well, better than stock markets worldwide. This is our live market open for fixed rates. I'm Yohay Elam of forexcrunch.com. Welcome to visit my site and to listen to the fresh podcast at Market Movers Podcast. So what do we have for you today? Well, we have a doom and gloom edition. Before we talk about let's look at stocks. Stocks are falling, and let's look at currencies and see what moves currencies. So we have euro dollar moving up. That's because the euro is a safe haven currency, and it enjoys the fear flows inside. And yen has the same reaction. Well, now we have some kind of recovery in dollar yen, but in general, the yen is stronger and dollar yen is falling. Pound dollar is sort of in the middle, so it's alongside the dollar, trading on the same ground. But the currencies that are suffering more are the Australian dollar, which is falling together with copper prices, and the Canadian dollar, which is at new highs above 134, and the New Zealand dollar, which, yes, again, now it is a bit of recovering, but in general, we're seeing here a fall. So what's going on, actually? First of all, let's look at the developments that we had yesterday. So the data we had yesterday was okay from the United States. We had the core PC price index rise to 1.3 as expected. This is a very important figure for the Federal Reserve. This is the key figure for measuring inflation. Then we had figures that were released at the same time, spending and income. One of them came just a bit above expectations, the other below. That was also okay. We had a small disappointment from pending home sales, but it's not the biggest figure, not the most important one. And then this morning, okay, this is already fresh news. We had Spanish CPI falling to 0.9%. But it's actually more the news than the economic data that moved the markets. So let's move on to the news. We had Dudley, William supported a rate hike in 2015. We talked about it yesterday, about if Dudley will walk with Yellen, making the case for rate hike, or being dovish as he was back in August. So he was, well, we can't say hawkish, but he was supportive of rate hike this year. Then we had John Williams of the San Francisco Fed. He also had the same tone, the same stance, talking about a rate hike in 2015. Okay? Why are these two people important? Both of them are centrist. Both of them have sort of the middle ground in the Fed, close to Yellen. And if they support the rate hike in 2015, and there's a good chance this will happen, Williams even talked about the option of raising rates already in October. We know that in October there is no press conference by Yellen, no new fresh forecasts by the Fed. That's why most market analysts expect a rate hike only in December. Okay, so this was supposed to be supportive of the dollar across the board, but stock markets didn't like it, and they didn't like also other stuff. Okay, so we had India slashing the interest rates more than expected. So let's show you pictures of these people. I think it'll be nice. So we had, this is William Dudley, see lifting his hand, talking about maybe raising the rates. And this is John Williams of the Fed also. I found a picture of him with his hand up in the air. Okay, but then we had this guy, Rajan, of the governor of the Bank of India, cutting the rates. Now, they were expected to cut the rates from 7.25 to 7%, just 25 basis points, because of the, well, deteriorating conditions, lower inflation, but they cut it all the way to 6.75. This wasn't expected. And the message by Rajan, which was a senior economist in Washington beforehand, that the global economy is slowing down. Now, India is one of the BRICS: Brazil, Russia, India, China, and South Africa. But contrary to the other countries, Russia exports oil. China, well, is a consumer of all the goods. Brazil exports commodities as well, and South Africa. India exports more services. Okay, so India was supposed to be the bright spot. And if India is slashing rates more than expected, is more worried, that's sort of bad news. Okay. Another development we had from the billionaire investor Carl Icahn. He's known as an activist. He always speaks out his mind about what companies should do, what the stock price should be, and things like that. But now he came out with a video, a warning called "Danger Ahead." So this is Carl Icahn. This is his website, and you can see a 15-minute video talking about doom and gloom, danger ahead. So he has some political statements, but regarding currencies, regarding stocks, he just talks about how there is some kind of inflation in stock markets, how he sees danger ahead for stocks, and how he fears that the Fed has been holding rates for too low, for too long, too low, and this could all burst. So all these sort of were negative developments on markets. Another one to watch is the price of copper. Of course, it fell below 5,000, which is a very round number, and this is also bad news. So all these things together triggered. Oh, I forgot Glencore. Glencore is an important stock in the mining sector. Now, they were always mired in debt. They always had some kind of trouble, but it was just another stock we don't talk about if we focus on currencies. But we had this attack of the hedge funds, the crash of commodity prices, and altogether, the stock tumbled down nearly 30% yesterday in London. Why am I talking about this stock? Because it has a big impact also on other stocks in the stock market, and also contributed to the global gloom. Let's see. Now let's move to the currencies. I don't know how many of you. I'll talk about why the euro strengthens in times of trouble. Okay. Well, since June of last year, the ECB, the European Central Bank, has a negative deposit rate. That means if you are lending money, if you're depositing money with the ECB, you are punished. You get less money at the end of the year. The ECB, European Central Bank, encourages us not to keep the money, to spend it out. So some is spent on the real economy, but some also moves outside the Eurozone. And it's very, very cheap to borrow in euros. In addition, they have this quantitative easing program. They buy bonds. It also makes it easy, makes interest rates very, very low in the Eurozone. So again, people buy in euros and spend it elsewhere. So that pushes the euro down. When everything's good, cheap money in euros moves out of the Eurozone and goes elsewhere. But when we have times of trouble, and it doesn't matter if the trouble comes from Greece, from Spain, doesn't matter, China, money is repatriated, comes back to the Eurozone, comes back to where it was lent from. Okay, so that's why we have in recent months, including when we had good news from Greece, we had the euro fall. And then we had bad news from Greece, we saw the euro strengthen. So this is what's happening now. So if we talk about the levels, we're currently at 112.52 because we're seeing sort of some kind of relax in the last few minutes. But we've seen the euro strengthen. Of course, the line at the top is 113. We've seen it attack this line last week. And then we've seen it fall back in range, back to the drawing board under 111. Yesterday, when the mood became worse, euro-dollar continued higher. And now, during the Asian session, it extended its gains. Okay, so 113 is the level above. 112.15 is the level to watch. And then 111.65 I've pointed out here. And the round level of 111. These are the levels I'm watching on euro-dollar. Let's jump over pound dollar and talk about the other safe haven currency, dollar yen. In Japan, we have traditionally had low interest rates, and Japan has always been the safe haven currency, the number one. So also here, we had last week, dollar yen strengthened above 121, reached 121.20. And from there, it began, a correction. But then when the mood became even worse, the correction intensified and turned into a free fall. We do see it having some support. Let me update this level right here, 119.20. Maybe you can mark that as a double bottom. We have a nicer double bottom in the Aussie. We'll reach that shortly. Now let's go back to pound dollar. Regarding the pound, we've seen much more stability in recent hours. Now, why is that? Because similar to the US dollar, also in the UK, also as in the US, there is talk of raising the interest rate. So in the UK, they'll move right after the Fed. That's why while the dollar weakened against the euro and the yen, it did strengthen against commodity currencies, and so did the pound. All right, so we have much more stability there. And now let's move on to commodity currencies. As we know, Canada exports oil. We had a new high in dollar CAD, 134.30. This is the highest level since 2004, breaking the level that we've seen last week. And well, a lot depends on oil, but a lot depends on the global mood. So we can see the price of oil will stand in the same place, and the Canadian dollar continue to decline. That's because of the global mood. Okay. Australian dollar, I mentioned it. Let's see it. We have a nice double bottom here at 96.35. We've seen also yesterday the battle. We talked about the battle around the 70 level, and then when the mood worsened in Asia, we had it fall to 96.35. This becomes a very strong support level to watch. Now we have some kind of recovery. We'll see if it manages to reach the 70 line. If we don't have a break above 70, I think we could have a break below the double bottom. Kiwi dollar was somewhat stronger yesterday. It managed to hold for quite some time above the support line there that you see in the middle of the chart at 63.10, and it reached even 64 when the mood was more optimistic. There's a reason why the Kiwi is stronger. New Zealand exports milk and other agricultural products, and not copper like Australia. So we saw it, but also here the Kiwi dollar also fell. It battled 63, battled the support line of 63.10. Now it's recovering, but we have to watch it. In general, the Kiwi is stronger, but it also depends on this global gloom and doom. So these are the main currency pairs I'm watching. Now let's talk about the others. Swiss franc is also some kind of safe haven, but it's important to remember that the Swiss National Bank intervenes in markets. So even if the Swiss franc strengthens because of the global depressing mood of the risk aversion, then it doesn't mean it'll stay for too long, because the Swiss National Bank does not like a strong currency. So they may intervene. So yesterday we had dollar Swiss at around 98, and now it has fallen to 97, but it's still in this wide trading range. And I think if it'll fall too much, we'll have the Swiss National Bank intervene. So I don't like this currency pair. It's trading in tandem with the euro. I think we have a very narrow trading range here. So yesterday at the beginning of the show, we were at 109.40, and today at 109.25. So that's not such a big difference, is it? Okay. Euro pound is moving higher thanks to this risk-averse mood. The euro is enjoying safe haven flows. The pound is sort of standing in the same place, standing pat against the US dollar. So we have the pair climbing to a 3-month high at 74.20. Once the mood improves, I think we have a chance to see this cross fall back down. It's unjustified given the situation in the Eurozone and the improving situation in the UK. Euro, yen, these are the two safe haven currencies, and they're moving more in tandem, more close to one another, and we're not seeing extreme moves. Also yesterday in the show, we talked about the 134 handle. Now it's moving a bit higher, 134.90, but all in all, it has a narrow range. 135.40 and 134.20 are levels I'm watching, but real support is at 133.20. Okay, let's move to a currency pair that everybody likes probably, because we talked about it quite a few times on the show thanks to your questions. Well, the global mood hurts pound yen, sorry. The dragon is beaten. The pound is not in demand, and the yen is very much in demand. So we had it fall quite a bit. So these are, well, now we're at 181.84. We had a low of 181, 180.96. Very round number. This pair has a lot of pips, promising pips for everybody, and that also means lots of dangers. So now we had a low of 181, and we're bouncing back quite high. Levels above are 182.50, 183.50, and 184.35 on the top side. On the downside, of course, we have the fresh support at 181. And let's add this line here, which is 180.30. Any questions so far? Before we move to the next, what's going on next in markets? I hope, this is my face here. I hope everybody understood the explanation about the global doom and gloom. The big question is, will this continue? Okay, so now let's move back to what we're having. Let's see what's up ahead on the road for us. So we talked about this, and okay, so at 12 GMT, we have a German CPI. We already have some releases from the various German states, and these also, of course, cause some movement in markets. But the most important figure is the final figure that is released at 12. So what are we expecting there? Well, the HACP, which is the sort of European standard, is expected to drop minus 0.1%, and year over year, it's expected to rise 0.1%. Very poor. Both figures are below the previous month, and I believe we could even have a lower figure, because what we've seen in Spain earlier this morning, right here, can you see the highlighted line? We had the HACP fall 1.2%. Double the expectations of 0.6. Now, Spain is probably the country, alongside Greece, that has the worst inflation rate. It goes hand in hand with high unemployment. So we've had good growth in Spain, but this growth was mostly based on falling prices. So we have the same amount of production, but prices are lower. That means that the real value is actually higher. So the growth in Spain is thanks to falling prices more than strong growth, but that's what we have here. And deflation was already below 1% in the past. It was expected to deteriorate because of oil prices, but not so sharply. A fall from minus 0.5 to minus 0.6 was expected, and we had double. So I believe that also in Germany, due to oil prices, due to other imported goods, we will see a worse deflation than expected. What does this all mean? Well, it means that the European Central Bank could accelerate its thoughts, its intentions to add more QE, to add more bond buys. We have a meeting in mid-October. The ECB is not expected to act, but it could hint about more action in mid-October and could act in December. Last week, we heard from Mario Draghi, the president of the ECB, that that there's no rush from the ECB to act. Means they're considering more quantitative easing, but there's no rush. They're more waiting for the Fed to act first. They would prefer a lower euro, but they want things to happen without them having to do any real work. Well, I guess don't we all want that kind of thing? But if inflation is a bit too low, and we could see that, we could have worse figures. We could have more action from the ECB sooner rather than later. So, of course, the inflation figures for today from Spain and from Germany give us a bigger hint about what we can expect tomorrow from the all-European CPI. Expectations stand on 0.1% positive, 0.1% not negative like in Spain for the CPI. and core CPI 0.9. But let's see, it might get worse. Okay. What else do we have today? United States, we have trade balance. It has an impact on GDP, and this is for the month of. This is good trade balance. We had last time minus 60 billion. I think we'll have something similar this time. Then more important stuff, perhaps prices of homes. Yesterday we had a sort of disappointing figure in pending home sales, but last week we had good figures. Now we'll see the Case-Shiller home price index for, I think it's for top 20 cities in the United States of America. And it's expected to show an annual year-over-year rise of 5.2%, above 5% last month. This is still, these are still healthy levels, not bubble levels, not a depression. So sort of the Goldilocks numbers, okay? And perhaps the most important figure is the consumer confidence. We're expecting the conference board's figure to drop from 101.5 to 96, because we've seen the University of Michigan's figures for September also fall. So that's why we're expecting this figure to fall. So when we have low expectations, this could mean positive surprise. If we have better consumer confidence in the United States, we could see the dollar strengthen a bit. Okay, and for those of you trading the British pound, we have a speech from Governor Mark Carney. Let's get a picture of him, also known as the George Clooney of central banking. So this guy here, he has a lot of impact, but he has lots of confusing messages as well. Mark Carney is a Canadian. He used to run the Bank of Canada before he joined the Bank of England in 2013. He often has bullish statements that boost the pound, and then when he talks in the name of the collective, not in his own name, but in the name of all the MPC members, all the Bank of England's members, he's more dovish. So on his own, he lifts the pound, and when he speaks for everybody, he sort of weighs back down. It's very confusing for markets. We might have some positive action for the pound from him today. So these are the big events for today. Now, towards our show tomorrow, let's talk about the events we have tomorrow. Tomorrow, at least here in Europe, we have retail sales from Japan. Well, last week we had disappointing inflation figures, and we talked about the chances of more action in 1 month's time. The Bank of Japan might act on October 30th, introduce more stimulus, weaken the yen. Now that we have a slightly stronger yen on this depressing global mood, and we'll have perhaps a disappointing figure from retail sales in Japan, the chances of action will rise, and this could weigh on the yen, send dollar yen back up. Okay, so let's see where we have this figure here. Let me change here the dates so we can see what we're expecting for tomorrow from Japan. Just 1 second. So Japanese retail sales. No, I don't have that figure. Sorry, I don't have that figure immediately at hand. Okay. At 1:30 GMT, we have Australian building approvals for the Australian dollar. We talked about this double bottom for Aussie dollar. This could be a make or break moment. So building approvals, we have them right here. Month over month, we're expecting a fall of 2% after a rise of 4.2%. That's important for those of you trading the Australian dollar. I find the Australian dollar quite interesting. Year over year, last time we had a rise of 13.4, so the Australian housing market is still okay, but it's not as important as, of course, the mining sector, right? We have also other figures from Australia and New Zealand. From Australia, private sector credit is important. For August, it's expected to rise 0.5. All in all, year over year, it rose 6.1, and if we have a slowdown in that, we could have a slide, right? And for tomorrow's morning before the show, just a second. Tomorrow at 6 GMT, we have so German figures are opening our mornings every time now. We have German retail sales expected to rise 0.2% month over month, or 3.1 year over year. They're still expected to show a healthy German economy. The German consumer is doing its job and buying stuff, and that should help the German economy. But of course, the results are still to be seen. And at 7:55, just 5 minutes before the show, we have the monthly employment figures from Germany. So we're expecting a drop of 5,000 people from the list of unemployed people. Of course, more good news, the German economy is doing well. The level of unemployment in the Eurozone's locomotive is at 6.4%, and it's not expected to change. But there is, of course, a divergence. As we all know, it's not new. Germany is doing well alongside a few other northern countries, and in the south of the continent, things aren't doing that well. We have from Spain, for example, tomorrow the current account balance. Today from Spain, we had a disappointing not only inflation numbers, but also retail sales disappointed by rising only 3.1 year over year. So this divergence still plays an important role. Have any questions? Okay, so let's move to the bigger themes moving the markets. Hope you can see the slide. Of course, the big question is around the Federal Reserve, to hike or not to hike. The big event is December, because in October there is no press conference. So we're expecting the Fed to move in December. We had 2 weeks ago, we had hints that they're not really into it. Maybe they'll call the whole thing off. They're hesitating. But then if the Fed is so dovish, so bearish, so depressed, maybe there's more trouble in other places. Maybe other central banks will move before. Then we had some optimism from the Fed last week from Janet Yellen, from good figures, and then yesterday from Dudley and from Williams. But this came out as a boomerang. So they were more optimistic about the US economy, mentioned the global economy less, but stock markets actually didn't like it at all. Why? Now, they did react to not the positive tone of the Fed, but rather the fact that interest rates are going to rise. And if interest rates are going to rise, then it's bad for stocks, and stocks are already suffering. Then we had troubles in stocks from quite a few places. We had just last week, we had Volkswagen, the German car maker. Well, it was discovered that they cheated on the emissions test. The stock fell quite a lot. Nothing related with China, nothing related with commodity prices, but that adds to a negative sentiment. And this week we have Glencore, which is very related to China, the fall in copper prices, the fall in iron prices, the huge debt that they took upon themselves. Their bonds suffered. The cost for covering a crash in bankruptcy of Glencore rose, the famous CDS. And this is related to China, to the global slowdown, to the fall in copper prices. So now a Fed hike in the market seems like a negative move. Another factor, we talked about this in previous shows, is the ECB. We had Draghi last week, and Draghi and his compatriots, his colleagues, especially the Lithuanian representatives, they talked about, they had no rush, they want to wait and see a change in forecasts, what's going on, and sort of the euro managed to rise once again because the ECB would not act. Now the ECB is coming back into focus because we have these inflation figures, and I see the figure from Spain today as an ominous sign, and perhaps we'll have increased talk of action coming sooner rather than later. So if we had ECB hesitation last week and it's still going on now, we could see things change quicker. And of course, the third theme, the second largest economy in the world, China, is slowing down. We didn't have any news. Last thing we heard from China was that they're considering more stimulus, but they've done this in the past, and I'm not sure they have many more tools in their shed, so to speak. And so China is, we had a bad figure from China last week, the Caixin manufacturing PMI, which fell to a new 6-year low. This week we have the final Caixin figure. So it's expected to confirm the score, 47 points. And we also have the official manufacturing PMI. So these figures come on Thursday, at the beginning of the new month. Let's take a look at other figures this week that are going to move markets, and tension is also already building towards them. Let's show you the slide here. So Wednesday, tomorrow, we have the ADP non-farm payrolls in the United States. It serves as a hint towards the official non-farm payrolls on Friday. Last time we had 191,000 jobs gained in the private sector. This time we're expecting more of the same, 190,000. And this is, of course, we'll talk about that more in detail tomorrow, but it's supposed to show a steady and ongoing, steady, continuous growth in jobs. Some will say mediocre, but there's also a big question. Do we prefer a steady and mediocre economy, or a glorious boom cycle followed with a bust? So I don't have a clear answer for that. Well, preferably we have a steady and above mediocre figure, but guess you can't have everything. Anyway, tomorrow we have ADP non-farm payrolls, and later, much later, tomorrow a speech by Janet Yellen. On Thursday, we have the US ISM manufacturing PMI. The manufacturing sector is small. In the United States, the bigger sector is services, much, much, much bigger. But manufacturing still has a significant impact. And this time, we won't have the services PMI before the non-farm payrolls. So the ISM manufacturing PMI on Thursday carries more weight, could have more impact on shaping the expectations for Friday. And Friday, non-farm payrolls, this time we're a bit far from the important rate decision in the United States. The important rate decision is in December. So that's 1, 2, 3 NFP reports away. So we have now one in October for September, then another one in November, and the third one in December until we have the big decision. So we'll need a really, really big surprise in order to change expectations. Nevertheless, it's always an important release. Markets are expecting a gain of 202,000 jobs, in line with figures seen in recent months, around 200,000. What I'm expecting more specifically is a big upwards revision for August. August is known to have poor readings and then only to be revised higher later on. So I think we'll have maybe a positive revision, and it'll make the report in general more positive. And of course, in the NFP, there's a rising importance for the level of wages. Okay, so we had a tightening labor market, more people come in getting jobs, but salaries in the United States remain low, or they do rise, but the annual level of growth is still around 2%, nothing more. So last month we had it rise just a bit to 2.2%, but that's within range. The range is 1.9 to 2.3%, what we had in the past year or so. I'm hopeful for a rise to 2.4% this time, and that could raise expectations for rate hike. But as we've seen, let me show you the chart once again. On the Aussie, it has, of course, a positive impact for the US dollar, but on the euro, when expectations rise for rate hike, we have more doom and gloom in stock markets. Of course, not on their own, together with other events in stock markets. And we have the euro rising as a safe haven currency against the US dollar. Okay. Do you have any questions? Who's in the room today? We have Aichus, if I'm reading that correctly, and Beans. Your questions are welcome. Okay. While we await your questions, let's see what other news we have coming today. We had some figures released just recently, just a few minutes ago from the UK. I didn't mention them because I didn't see them as the most important ones, but let's cover them in any case. We had net lending to individuals, month-over-month rise to 4.3 billion, better than expected. This reflects more activity in the UK. We talked about the fact that the economy in the United Kingdom is doing quite well, and that the Bank of England, Mark Carney, let me show you his face again here. He's expected to raise rates, but he also has he's the top figure in the Bank of England, but he doesn't make decisions on his own, let's put it this way. I think Janet Yellen of the Federal Reserve has the first word. So the Bank of England is expected to raise rates only after the Federal Reserve, okay? So we're seeing an improvement in the UK economy in terms of net lending. On the other hand, consumer credit is just a bit lower, but mortgage approvals are higher, 71,000. It's better than expected and continues the upward trend. Money supply is a bit down, but that's M4, it's not that important. All in all, the UK economy, I prefer to see the glass half full in this case, and we have rising chances of rate hike sooner rather than later in the UK. Okay, figures that we have just after the show. We have some figures from the Eurozone. Well, these are third-tier figures, not worth mentioning. But the next big event for the Euro is this one, HACP or CPI from Germany. So year over year is what matters most. So in the German national figures, we're expecting a minor rise of 0.1%. And in the HACP, the European standard, a fall of 0.1%. All in all, quite balanced. If we look at changes in prices, it's very balanced, very stable, but it's not what central banks want to see. Central banks want to see prices rise by 2% year over year. That's the holy grail. Euro dollar is falling. Perhaps we had some releases from various German states which are negative. Let me look up this data for you and see if we have some. Yeah, we have negative figures. For instance, one of the biggest German states is North Rhine-Westphalia. I hope I'm pronouncing that correctly. So they've seen prices fall by 0.2% in September. Last month was plus 0.1%. Or year over year, we had it drop from plus 0.2 to 0%. So that's one of the most industrialized German states in the Federal Republic of Germany. And if prices there are slowing down, falling month over month, stalling year over year, it's not good news. Another German state, Brandenburg, they have seen a drop of 0.2 in prices month over month, and year over year we have minus 0.3, worse than minus 0.1. So it's also bad news for the euro, for Germany. It implies more action. Bavaria, a rich state in the south of Germany, where Munich is, they have seen a fall of 0.2 in prices, also worse than last time, and year over year also flat. Hesse, where Frankfurt is, have seen a fall of 0.3 and also flat year over year. All in all these state figures, we haven't had all states and we don't have the full number yet. All of these do push euro dollar lower, because if inflation is weak in Germany, and we've seen also beforehand this big negative surprise in Spain with a drop of 1.2 in prices right here. This implies also a weak Eurozone inflation figure tomorrow, and implies, of course, more action from the ECB, more euro printing to weaken the euro in general. So doom and gloom is, of course, negative for the US dollar against the safe haven euro and yen. But if in these safe haven currencies, in the central banks think of in printing more euros, printing more yens, doing more monetary stimulus, it's of course negative for both currencies, also against the US dollar. For commodity currencies, more printing is positive, preferably in the US, but printed euros and printed yens are also welcome in Australia, Canada, and New Zealand. Okay, so we have, let's see if we have any questions. Yesterday, you guys were very active, and we answered your questions in depth about pound yen, about the Aussie dollar, about general trading topics. Be glad to hear from you also today and also tomorrow and also in the next few days. So, okay, if we don't have any more questions, I guess we can begin to wrap up. Let me share the screen and show you what I've prepared for you today. So this is the live market open for September 29th. I'm Yohay Elam of ForexCrunch.com for FX Street. Recent developments, data we had, more or less things came out as expected in the United States. Core PCE rose to 1.3. That's a figure watched by the Fed. Other figures were quite balanced in general, but we had bad news from Spain this morning with CPI falling more than expected. The bigger news, the doom and gloom news, come from all fronts. So we had Bill Dudley supporting a rate hike in 2015, and then also John Williams. Both are important centrist Fed members, and if they support a rate hike, it's supposed to be good news for the US economy, but it turned into bad news for stock markets, and this came on top of other bad news for stock markets. India slashed its interest rate more than expected, 0.5%, and they cited global weakness. India was supposed to be the bright spot in the global economy, especially in the emerging markets, in the BRICS countries. Another feature, another specific stock, another is Glencore. We had its stock crash around 30% yesterday, and this is an important mining stock. This is, of course, related to copper, which dropped under the $5,000 mark, and it's a psychological level. And we had Carl Icahn, the billionaire investor activist, warn of the danger ahead for corporate America, for stocks, for politics, and that also added to the gloom and doom atmosphere. Okay, so the reaction that we've seen, now we're seeing some kind of correction, but euro is a safe haven, it went up. The yen, it's a safe haven, it fell, it went up, that means dollar yen fell to support at 119.20. Euro dollar didn't reach 113, but it went up. Pound dollar is sort of stuck in the middle between the safe havens and the commodities, so it's more or less in place. Dollar CAD has reached new 11-year lows above 134, 134.30. Aussie dollar made a double bottom at 69.35. It's a very interesting pattern to watch. The Kiwi dollar dropped as well, 63.30. During the show, we're seeing some kind of recovery, but in general, we'll have to see if it's sustained and if we don't have this gloom and doom atmosphere rolling into the next sessions. Moving ahead, we have 12 GMT, the German CPI, then US trade balance, Case-Shiller home prices. More importantly, consumer confidence in the United States at 2 GMT. And then for those of you trading the pound, we have a speech by Mark Carney. When he speaks on his own, he's a bit more bullish. the most immediate thing, as I said, German CPI at 12 GMT, and early signs are that it'll be negative, and that could push the euro lower. So, and these are the events, most important ones for today. We'll have to see if the doom and gloom atmosphere continues, pushing higher the euro and the yen and pushing down commodity prices, or that we have some kind of improvement in the atmosphere. We'll have to see perhaps stronger consumer confidence in the United States. So that's the wrap up for today. And now I see we have questions. We have a question from Pan. Pan says, sorry, does that mean more bullishness if Kiwi introduced in yen, in Aussie and Kiwi? So thanks for the question. Yes, if we have the Bank of Japan printing more money, it means a weaker Japanese yen, because, well, more yens means less value for the Japanese yen, and this money eventually flows. And where does it flow to? Riskier assets. The Aussie and the Kiwi are riskier assets, and they're fueled by this easier money. It's important to remember that, contrary to many other developed countries, in Australia we have a positive interest rate of 2%, and in New Zealand 2.75. So so these were the classic carry trades. So I hope this answers the question. Hello, Vedran. Good to see you here today. Thanks for your questions yesterday. And I guess that's all. If we don't have any more questions, last moment questions. So thank you very much. Been a Yohay Elam of Forex Crunch Market Movers podcast for FX Trade, doing the live morning show. Thank you, everybody. You can see a wrap up and the full show also recorded. And see you guys tomorrow. Goodbye.